2 months into 2026, and this year is off to a hot start. But what's in store for the rest of this year? Where should our focus be? What should be concerning us? And what could potentially come out of left field and knock us out? All of this and more is going to be packed into the next 30 plus minutes of T-Lop. Check this out. Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and joining me from the T-Lop team, I got Marketing Mike, I got Money Mark, and our producer extraordinaire, Karina Mojica. Pew, 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 pew. What's up, y'all?
What up? I need to figure out my intro thing.
You need to figure out your intro thing. Like, I need to figure out my intro thing. It's kind of like Ricky Bobby being like, I don't know what to do with my hands.
Right.
Like when JC's on here, he's like, hey, what's popping? All you need, Karina, is like a what's popping.
Yeah,
I'm Ron Burgundy.
I want to be special.
Yeah, I'm Ron
Maybe you go
Burgundy?
like, maybe you're like.
What if you actually went with like I'm Karina Mojica? Right?
I like that too.
Play well.
Yeah, Special K. Like,
I
she's
love
our
that.
girl, right?
Yes.
She's everybody's little sister. Actually, she's your baby sister-in-law, but for the rest of it, she's everybody's baby sister. She is our producer extraordinaire. And I'm excited about today's episode. Like, shout out to Mike, actually, for throwing it out there. It's like, hey, I kind of love it when Gary Vee talks about what he thinks is going to happen in the market.
Yeah.
I was like, okay, we can kind of do that. He's like, but you have to make a bold statement, Dio, so that the people can come back and either be like, bro, you're dead wrong, or holy shit, you actually may know a thing or two.
Right.
So I don't know how bold of statements we're going to make, but we can talk about the mortgage and real estate landscape. We can talk about the political landscape. We can talk about the new Fed governor, right? We can talk about where interest rates are going to go. We can talk about when home ownership is going to become more affordable.
Yes.
Right? Like, these are all things that we can jump into. And I mean, honestly, we could look at Karina and say, Karina, where do you want us to start? Would you want us to start with talking about the political landscape? Do you want us to talk about where interest rates are going to end up? What's going on with homeownership affordability? What are some things that we should be concerned about if we're mortgage lenders? What are some things that should excite us?
I'm going to go with home ownership affordability.
Home ownership affordability for two, Alex.
Let's do it.
Yeah. Do you even know what that means? Do you know who Alex Trebek is?
No.
You ever heard of Jeopardy?
The game, yeah.
Yeah.
The show?
Yeah.
He's the guy.
Yeah,
That's the guy.
he's the guy.
Okay,
Well,
he's the guy.
Now
Yeah,
it's
yeah.
not because he
Well,
passed
that's the guy.
away. Rest in peace. But
Oh, wow.
we now have Ken Jennings.
Okay.
Yeah. Okay. Anyhow,
I
that
don't
is.
know them, yeah, but
Yeah,
okay.
that's where that stems from. So homeownership affordability.
Yeah.
I was just on a group call with a bunch of Mark's originators over at T-Lop's Originator Coaching, and this question comes up, and the answer is not a good answer. It's the truth, right? I kind of feel like Jack Nicholson. You can't handle the truth. It's the truth. You want to know when homeownership becomes more affordable? When this happens. We're going to see interest rates steadily stay the same or decline slightly. Okay, that's a little bit of a bold prediction. Mm-hmm. We're going to see incomes continue to increase, yet it's a little bit odd because the labor market is starting to slow. And we're going to see home prices stagnate. Mm-hmm. So if you were to draw that out on a chart, right? We almost need like Stephen Barnett in here with his fancy calculators and his graphs and his Excel spreadsheets.
Yes.
But what you would see if we're in 26 and homeownership affordability was scored at a level of, let's just say, C minus. We get to 28, it's a C plus. When we get to 30, it's going to be a B minus. When we get to 32, it's a B plus. Like when we look out 3, 5, and 7 years, homeownership will become more affordable, but unfortunately, not drastically. It's not going to become more affordable overnight, and it's only going to become more affordable because rates will slowly continue to decline, which they've been doing. Home values will stagnate, they'll flatline, and wage growth will continue to increase for some people, but not all people. And unfortunately, I still think there's going to be a growing trend of haves and have-nots.
Yeah.
So I think homeownership will become more affordable for those that are dual income, for those that are making 1.5 to 2 times the median.
In 26, you're saying?
It'll start in 26.
That's like a 5-year run, you're saying?
It'll start
It's usually
in
a 10-year cycle? Is that how it goes?
It depends on what you're looking cycle-wise. I can't imagine.
Just interest rates. And,
yeah, I mean, the last time homeownership was affordable, it took a once-in-a-lifetime catastrophic event called the financial crisis, right?
Yeah.
The Great Recession for that to happen.
Yeah.
Karina was a baby when that happened. Mark, you were probably in elementary school, right? Where were you in 2008?
I was in high school.
You were in high school.
Yeah.
Okay, so Mark's in high school. Karina's in kindergarten.
High school.
You were still high school too.
I was senior year. Yeah.
No,
God,
I was a
dog,
junior.
am I old? Okay, so for all of you and your friends out there, yeah, that was the last time that homeownership was affordable. Now, it was extremely affordable from like 11 all the way through 16. By the time we got to 18, 19, that's when it started becoming a little bit reminiscent of what it was in 04, 05. But unfortunately, if you want to make homeownership drastically affordable, you have to go wave a magic wand, and you have to be able to build 5 million housing units.
Yes.
If you built 5 million housing units, all of a sudden we wouldn't have a supply issue. We'd have plenty of supply, at which point we may have a demand issue. Well, when you have more supply and less demand, that's when values come down.
Right.
But I think what we're looking for ideally, it's a game of chess right now. If you're looking for homeownership to become more affordable, it'll happen slowly over time, which is why we remind home buyers, you buy a house when you're ready. You buy a house when you can afford it. You buy a house when life dictates it, right? Like life dictated for you, Mark, that you sold your condo in Chicago and you moved to Orlando. You'll buy a home next year, right? Once you get settled into Orlando, you'll buy a home, and you'll buy a home because your career brought you to this place.
Right.
You had a great interest rate. Did
Had.
you not? Had.
Had. It was
You
during
had.
COVID.
Had, right.
Yeah,
Yeah.
but you moved so your income could go up.
Yes.
Yeah, and if you buy,
Right?
you got to buy. You can't time the market. It's like
Right.
really
No.
difficult.
No, it's time in market, but this whole like, oh, we need to make homeownership more affordable. Everything that people want to try, it's truly like giving a sip of water to somebody who's dying of thirst and hunger.
Yeah.
Don't get me wrong, the sip of water may prolong things a little bit, right? It may give them an extra day or two, and maybe by then help is on the way. But right now, anything being proposed isn't overly, it's not overly advantageous for the home buyer who's like wanting things to become more affordable. That's just not happening. Now, maybe with AI, we fast forward to 2030, and it's a whole new ball game, something we've never lived in before. That could be your once a decade type cycle.
Exactly, yeah.
That could come out of left field that we weren't anticipating, we couldn't predict. It knocks us on our ass, preferably in a good way.
Yeah.
2008 knocked us on our ass, not in a good way.
But you said 2028, it gets better. You said 2030, you would rate it a B or a B plus.
Correct.
Right? So
Yeah.
that's great, but that goes in line with the 10-year cycle.
Yes.
So that's
yes.
awesome.
Yeah,
Yeah.
assuming all things, well, that 2028 would be a 20-year cycle.
Yeah.
I mean,
Well,
things,
right,
but then
right.
things stopped being affordable-ish in 18, 19, 20. They got exasperated in 20 and 21. Like we pushed a decade worth of income and a decade worth of growth into those 2 years because of all the stimulation that the government participated in. So we now get to spend all of the 2020s basically bleeding through all of that stimulus to get to 2030. Because homeownership wasn't this bad in 2018.
Yeah.
But I don't know if it was overly affordable in 2018. You were going to say?
Yeah, you mentioned the affordability, interest rates will get better, let's say going into 2030. But you also mentioned the disparity between the have and have-nots also increases. Why is that?
The disparity between the have and the have-nots is the way that our government's currently set up, the way that the financial system is set up. Right? I'm talking Wall Street. I'm talking investment banking. It is one in which all we create is debt. We're not creating and manufacturing goods. We're not reinvesting back into factories.
Correct.
Okay, so that cuts out most of lower middle class. It cuts out middle America, right? So it's one of those things that when the economy is doing well, the rich get richer. I mean, you look at how the stock market's doing. If you take out 5 stocks, the stock market's not doing that well. But those 5 stocks make everything else look amazing, right? So it's one of those, the way that our current economic system is set up is one in which it favors it favors those that already have money. It doesn't favor those that are trying to generate wealth, except for through home ownership.
Right.
However, anyone who has a lot of stamps on their passport can tell you 2 things, and try not to be political here. 2, if you have enough stamps on your passport, you can realize how alike we all are when you travel the world. I mean, you know this playing ball over in Europe, that how other countries may be different, but they're not worse or better.
Right.
But you also realize how freaking great we have it in the U.S.
Yeah.
Like, I mean, I was in Costa Rica and I had a kid tell me, he's like, I will never be a doctor. I'm like, bullshit. You're super smart. You can be a doctor. He's like, no. I was born into a family that I won't be afforded the opportunity to go to the right schools to become a doctor. Where at least in the U.S., you might not start with a silver spoon in your mouth. You might start with two hands tied behind your back, but no one's going to prevent you from being able to go to medical school to become a doctor, even if they threw a bunch of obstacles in your way. So,
and there, like what you said, like there is so much equity right now. I mean, everyone has so much equity, and I'm sure the current administration, the next administration, I think they have to take that into consideration.
Well, where's the equity going to go? You know, it's going to go
until you sell. Yeah, it doesn't go anywhere.
But ready, I'm going to tell you where it's going to go. My parents are going to sell their home, or they're going to pass away in 10 or 15 or 20 years, and my sister and I are going to inherit their house. When we inherit their house, let's say it's worth $500,000. That $500,000 is going to two people. I don't need it.
Right.
I don't need that money. My kids don't need that money, but that's where it's going to go to.
Right.
Right. It's not going to be passed down to people who do need it. And I'm not going to take that money and go reinvest it into manufacturing or into creating a business per se. It's interesting. I read an article, and we're way over time to get our sponsors ad in, but I promise you, Karina, I'll find a way to take a stop and slide it in. Y'all can't see this, but off camera, she's like flashing me gang signs right now.
She's holding the three up.
She's giving me death stares.
Yeah, she
like,
looks mad.
Like, hey, we need to get our sponsors ad run right now. But I read this really cool article where it's something crazy. Like, you look at the money that Goldman Sachs invests. You look at the money that JP Morgan invests or Bank of America. And only like 8% of the money is being lent to companies so they can build and create.
Wow. Yeah.
It's typically the money that they're making is all in like crazy swap exchanges and investment vehicles. That is
it's just
a
magic
little
money.
bit of a, it's a magic
We're not
money.
building infrastructure.
Yeah,
like,
correct.
Yeah.
So we kind of went on a tangent there, but my short answer is homeownership will get more affordable as every year passes, and it's more affordable right now than it was in 2025. It's projected to be more affordable in 27 than it was in 26, but it's not going to happen overnight unless something catastrophic happens that comes out of left field.
You see controlled trend line.
Yeah, controlled trend line, unless AI steps in and all of a sudden we're living this crazy life that looked nothing like the lives that we lived the first 25, 35, or 45 years of our lives.
Correct.
So let's do this to make Karina happy. Okay, let's go ahead and take a quick pause. We have some bills to pay. Let's listen to this message from today's show sponsor. Y'all, something big is happening at Lower Mortgage. And if you're paying attention to this industry, you've probably noticed. In just the last month alone, Lower has added some serious horsepower. We're talking top producers representing over $350 million in volume. These aren't rookies kicking tires. These are heavy hitters who've done their homework and made the move. That should tell you something. On top of that, Lower just acquired Movoto, a top 5 real estate portal with over 150 visitors just last year. Before that, they brought in Neat Labs, and now they're launching Lower OS, a next-gen mortgage platform that's cutting loan delivery times down to 10 days. This isn't a company standing still. Lower doubled their volume last year, and they're projecting another 40 to 50% growth this year. The best in the business are taking notice, and they're voting with their feet. Here's the reality. The companies that are going to win in this market are the ones investing in technology, building real infrastructure, and competing at scale. Lower is doing all of that. They're going head to head with the Rockets of the world. And they're built for originators, not against them. If you're a producer who wants to be a part of something that's actually going somewhere, not just surviving, but growing, this is the moment. Lower Mortgage, the momentum is real. You can check them out and find more information by going to company.lower.com. Or you can always reach out to my dude, Craig Montgomery, and make sure you tell him T-Lop said what's up. All right, and we're back. So that was a long one. That was like a solid 10 minutes on that one topic. We want to talk about the political landscape of 2026. Y'all want to touch this?
Absolutely.
Not really.
Not
yeah,
really?
I know.
I mean,
in a respectful
I got
way.
family members watching.
Yeah.
oh, I have family members watching too. I have friends watching. And by the way, this is coming from someone. I'll preface this: I am unapologetically moderate. I'm as purple comes. I try to dislike all political parties. I don't understand the fanaticism. I don't believe in having to vote one way because that team wears a certain jersey. And I distrust most. To me, they are the WWE or the WWF wrestlers, right? Where on camera they hate each other, behind the scenes they're partying together, hugging it up, and all they care about is, do I get booked for the next show?
Right.
Am I going to get a raise? Am I keeping the money? Right. That's where I believe most of our politicians are.
Care about their pockets.
I like that comparison.
Yes.
Yeah,
Yep.
like
So, but here's what I'm seeing as an outsider looking in. We had the midterm elections coming up in November.
Yep.
Okay. We currently have an administration that their strategy, I'm not saying this is good, I'm not saying this is bad, and I'm not saying this is indifferent. I'm just saying it is what it is. Their strategy is strategy of chaos, right? It's like I joke about the spaz tweets that happen at 2 a.m., right? That's strategic, right? That's not someone who's senile. That's not somebody who has lost his mind. No, this is somebody that says, this is my strategy. It's worked in the past. I think it's going to work.
The guy's
in
a
the
master
future.
of psychology.
So whether it was taught in a book or whether it was learned, during adolescence. So right now it's not looking good, although it normally doesn't look good. Whoever the in power is typically loses power in a midterm election, especially historically when that power is unified, which it currently is, right? House, Senate, and presidency, all same party.
Yeah.
So running up into the midterms, we've already seen a lot of chaos. We're going to see more. Like I predict more. The one thing I do like about the market anymore doesn't even move to the chaos. What worries me is I don't think that Captain Chaos would back down because it's not working. My fear is that they would double down on the efforts. And it is good to know that the market tends to respond typically to emotion, typically to fear. So it's going to be interesting as we get closer to November, what type of manipulation is attempted. And by the way, I'm not saying by one particular party because they all manipulate. I'm pretty contrarian across the board. I can talk about the previous administration and how they manipulated the jobs numbers or manipulated this data to get the right readings and the right reports so that they can get the market to move in a certain direction to get voters to vote in a certain direction.
School loan debt.
Gerrymandering. Why? So what
That's
does it
a whole
mean?
nother type of manipulation that I wish was just totally outlawed and banned altogether.
Well, yeah.
Whether you're Texas or California, I don't
Absolutely.
give two shits. But
Yeah, county
no,
lines and all that. But
Yeah.
what does it mean midterms? Like, let's say it does
Well,
it does go conservative. Like,
What
what does it mean for the real estate market?
So,
Or in your opinion?
Yeah, well, it already is. It's Republican House, Republican Senate.
Yeah.
The majorities are had on both sides, even with Vance in the Senate being the deciding vote in case someone gets sick, dies, or resigns.
Yep.
And obviously the president's Republican. So if the midterms go against the current administration, that means the House is now democratically controlled, and or the Senate, right?
Correct.
Either one, but both would be deadlock.
Yeah.
Oh, it would be chaos. All of a sudden, you're going to get these people wanting to impeach the president and wanting to impeach this person, impeach that person. But for the market, overall,
What does the noise mean for the market?
lower interest rates.
Why does that
Right?
mean lower interest rate?
So it depends. Hold on. I'm going to contradict myself. It typically would mean lower interest rates because nothing's getting done. People will lose confidence. And when you lose confidence, you quit investing. You quit investing, now all of a sudden the prices of things go down, at which point you have to stimulate the economy through making borrowing cheaper. Right? So everything that we do, and from an economic standpoint, my opinion, house of cards. Right? It's all a house of cards, all a shell game. Three card Monty, right? Watch my hands, watch my hands, watch my hands. And we have a new Federal Reserve chairman coming in.
Yeah.
Right. And
let's
that
talk about
chairman
that.
was hand selected by the president, but it's odd. I can't imagine this was his pick, but maybe it was the pick that his team put in front of him and said, this is the guy to go with. This guy isn't as like cut as some other people he could have put in there. And the Federal Reserve doesn't dictate mortgage rates. We all know that. If you don't know that, there's your lesson of the day. The Federal Reserve does not dictate mortgage rates. The Federal Reserve dictates monetary policy, right? The Federal Reserve dictates car loans, home equity lines of credit cards, how much banks charge each other to borrow money, but not interest rates. But they do monetary policy. So if monetary policy starts going one direction, then the traders on Wall Street will start trading in a certain direction. And one could say, long term, if you cut the federal funds rate, you can see mortgage rates go down. Mm-hmm. Now, the previous 2 times that we cut the federal funds rate, mortgage rates went up that same day, right? So we always had to keep that in mind. But the end goal is to change monetary policy. And it's a weird conundrum for the current administration to be in, because on one side, you want to say, the economy is doing terrible. You need to drop rates. But then who wants to run for election on a bad economy? Mm-hmm. So you need to say the economy is doing well, but then you also have to somehow get rates artificially lowered.
Yeah.
Now, the way you could do that is how we've done it in the past, is through stimulation. So you can send the Federal Reserve out to start purchasing a bunch of mortgage-backed securities. The president,
I believe that's what he suggested.
Correct.
Okay.
And Bill Pulte Jr., the director of the FHFA, also kind of came from him. Mm. But it was like, what was it, $200 billion?
Yeah.
So $200 billion of purchasing mortgage-backed securities would 100% lower mortgage rates for about 6 weeks. And then if you don't have another $200 billion behind it, like, okay. I mean, that would be like you having a product, Mike. You're like, how do I get an extra $2,000 on these golf carts, right? You have a company that you make electric fancy golf carts for rich people that like to live in those golf cart communities. They don't want to drive their cars, so
Oddly
they throw
specific.
Yeah, they look. These are my friends. What are you talking about? These are my friends. So anyhow, like imagine if you only had 6 left, and you weren't going to order any more,
right?
And you had high demand. Well, you would just tack on a 50% surcharge because you knew you'd get them. Mm-hmm. However, if you were taking an order of 12 more the next week, you couldn't get that price because you wouldn't have enough demand. So that's what's going to happen if you start saying, we're going to take Fannie and Freddie's money. That, by the way, this is their reserves. This is like me going to your savings account and say, hey, you and Ari have X amount of dollars saved in case you have a bad month or two. Mm-hmm. And me saying, nah, Mike, we're going to take that money and go buy real estate with it.
Yeah.
Which, okay, it may be a good investment.
It's a little dicey, a little risky.
If you need to get that money out, you have to sell the home.
Right.
That doesn't happen overnight. Right? So the Federal Reserve, or the Fannie Mae and Freddie Mac can use their cash to go purchase mortgage-backed securities, at which point we have a artificial demand that drives prices up. It drives yields down, which is what rates end up being cheaper. However, what happens once that's been absorbed? We're creating new MBSs every single day. Mm-hmm. If there's not someone behind it to buy, it's not going to be a long-term play. Yeah. The Federal Reserve, back during COVID, no, they were like Pac-Man eating that shit up.
100%.
Which is how we got rates down as low as we did. Yeah. So overall, prediction, that's what the show's about. Yeah. Prediction, yes, we will see mortgage rates lower at the end of this year than we do higher. And that's going to be 3 factors. First, the economy is slowing. Just go talk to someone about their career, about their industry, right? We talked on a previous show with the mortgage industry being worn the fuck out. Mm-hmm. I got plenty of friends. I talked to them about their industries, and they're like, yeah, we're worn the fuck out.
It's across the board.
It's across the board. So that alone, we would see inflation come down. We would see spending come down. That would allow the Federal Reserve to become a little bit more dovish in their approach to economic policy. Yeah. They would lower their rates. Stock market would flutter a little bit, and then you could see mortgage rates coming down. You're going to have this administration doing everything in their power to try to manipulate the rates lower. And I'm not saying it's a bad thing. I'm just saying that's a thing. And you have the new Federal Reserve chairperson. Like, all of that is happening. Also all around the midterms in November. So we get to the end of this year, if we're currently sitting at 6.2, we could easily get down to like 5.8. But we're not going to get down to 4.8. Like 4.8 was going to take something super catastrophic. 3.8, don't even like hold your breath on that. Yeah. I said that once before and I had to eat crow, but I just can't see that happening.
But when you look at interest rates from the past, and I don't want to prolong this episode, but when you look at interest rates from the past 40 years, I mean, we were up, we hit all the way to 18%, and that was common. So even 70s, where we're at now is a pretty good spot.
6 is a really good rate.
Yeah.
5.5 is a great rate.
Granted, I have 2.75 because I'm on 2020, but it's a good rate. There's no reason to hesitate in purchasing a home right now, in my opinion.
Yeah, no, definitely.
When were mortgage rates the highest? What year?
Oh, that would have been like 79, 80, 81, that time.
That time, close.
That time frame.
I'm just trying to validate myself.
Okay.
You did it.
Yeah. It would have been there. Like if you want to go back into that time frame, we were in stagflation. So you know what stagflation is? Do you remember learning that in high school economics, Karina?
No.
Not one bit, huh? Really simple.
I'm sure I learned it. I love economic. Well, I loved it.
Yeah.
Maybe it was just my teacher. I don't know. But
Yeah. Was he cute?
No.
Not at all. But he was a good teacher.
Yes.
Perfect.
Yes.
It's when you have really high inflation and you have a recession going on at the same time. So your economy is not growing, yet the cost of goods are just absolutely expanding. It's called stagflation.
Yeah.
It's been rumored a couple times in the past decade, oh, we're going to be entering stagflation. I haven't seen it yet. It's a really cool terminology. I don't think I want to live through that.
No.
It sounds awful.
Yeah. But that's when interest rates were the worst, Mark. Yeah. What else did I have on my list of things that we were gonna tackle today? Because I think that one wrapped up. Like we talked a little bit about look, we have the midterm elections. We have a new Fed governor coming in. What's going to happen with home sales? Hey, home sales will be better this year than they were last year. That's pretty easy. Do we have a refi boom coming? That's a difficult one. Now, Steve and I were just out to lunch last week with a founder CEO of a top 25 IMB. And this guy works a lot with home builders. And this guy basically said one of his friends who's the CEO of a home builder, he thinks in 9 months we could be in a boom. So whatever he's prognosticating, he's seeing rates probably in the 5.5. He's seeing a growing economy.
Yeah.
He's seeing wage growth, inflation in check. And we have a bit of a boom going on. I'm not that optimistic.
I feel like they said that last year.
I feel like they say it every year.
2020. Yeah.
I am not. I mean, don't get me wrong. I love it. For someone who runs a coaching company, here's what I can tell you. And by the way, this is backwards.
Yeah.
When LOs have money, they want to spend money on coaching. When LOs don't have any business, they don't want to spend money on coaching. I'm like, bitch, that's when you need it.
Right.
Like you need it
Right.
when you don't have business. Right? Like you want it when you have plenty of business because it does make you better. It helps you be held accountable and it gives you purpose and lets you come learn from others who are doing it at a high level. But man, the last time you want to skimp is when things get tough. This is when you need as many weapons in your arsenal and as many people that have your back.
Yeah.
But that's just the way of the world. So for us running our coaching company, I would love for things to start booming because that many more LOs are going to have that much money to spend coming to learn with us and invest with our platform.
Absolutely.
But I'm not that optimistic. I mean, refi boom, okay, let's think about it. In certain states, if rates sneeze lower by 0.25%, think Ohio, think Minnesota, they refi. States like Florida, I mean, you have to get at least 75 basis points to a full 100 basis points. So a full 1% lower before we start doing a refi. And I don't know about California or Texas, but quite honestly, if you're running a mortgage operation, the only 3 states you should really care about are California, Texas, and Florida, because that's probably about, 45 to 50% of the mortgage market.
Yeah.
And then if that's going to happen, I have to battle the tech-enabled servicers, the tech-enabled national lenders to get in front of that consumer to be able to produce a loan low enough. I tell you what, if I'm a retail originator and we do go into a refi boom, I'm going to find a way to work with my company to set up some kind of a consumer direct division. I will let that consumer direct division call every one of my past clients, convert every one of my refi opportunities, and pay me 50 basis points.
100%.
Because as a whole, most of us aren't good enough. We're not aggressive enough to do it. And I would rather make 50 basis points on 10 or 20 million in volume than 125 basis points on $4 or $5 million in volume. However, most LOs won't do that. Yeah. Most brokers won't allow that to happen on their behalf, even if it's for their benefit. But I am not in the camp that we're going to see this big refi boom. I think a mini refi boom happens. However, I think the traditional broker and the traditional LO captures way less of it than they historically have captured because they get beat by someone bigger with more technology, and they can produce that loan at way cheaper. And instead of trying to fight them, I'd say join them, which is why I'd say figure out how to do that yourself.
Yeah.
pay a team to do that on your behalf, and go focus on doing what you do really well, which is build relationships, be your local community expert, generate purchase leads, and close those things at full comp.
Yeah.
Because those big dogs are going to be fat and happy doing their refis until they're not. And then when we get out to 27, 28, I think we're getting too far out. Like, I mean, we have a presidential election in 28.
Yeah, dude, it's
I don't think
so many variables.
I'm not foreseeing 27 to be drastically better than 26. I think we're in this slow climb back to whatever our new normal is going to look like, and I don't think we've ever lived in a new normal.
Right.
Never have we seen a new normal with this last caveat, because it's happening right now. Right now, China is threatening to not purchase our mortgage-backed securities.
Right.
Okay, at what scale? How much are they doing their own spaz tweeting, right?
Yeah.
How much is this like pomp and circumstance and they're peacocking around and it's not really valid? But if it is valid, then all of a sudden, like our largest purchaser of these securities, this is how mortgage rates stay low. If they're not buying, all of a sudden rates are going to go up. It's supply and demand. And it doesn't matter what's going on in the economy. So that's something that we have to keep an eye out. But all in all, if I were to summarize this in 30 seconds or less, I think it's more of the same that we've witnessed over the past 12 to 24 months, getting slightly better as every quarter passes.
Yeah, all the same, but slightly better.
Yeah. And it sounds like it's, not a drastic, bold prediction, but look, I have a 1 in 3 shot of being right.
Sounds like
That's right.
I have a 1 in 3
It's gonna
shot
say
of being
the same,
right.
get better or get worse.
Yeah.
So put your hat on and just keep fucking working.
Yeah, correct. Like
Right.
you control what you can control, your attitude and your effort.
Right.
Like your attitude and your effort. If you're a leader, here's what you control. Are you loving? Are you disciplining? And are you offering structure to your teams? Right? If you're an originator, are you putting yourself in a position where you're loved, where there's structure, where you're having discipline?
Yeah.
You control what you can control. It's your attitude and your effort. And I'll tell you this, and I think I mentioned this on a previous episode, maybe we can wrap up on this. Because we don't really know what 2030 looks like, I'm going to encourage you to act as if by 2030 you're not needed. And you only have 5 years to make the most amount of money that you can make.
Agentic agents.
Yes. What would you do different? What would you start doing now that you weren't doing before if I told you that you only had 5 years to make 20 years worth of income? By the way, you only need 5 years. I mean, I'm telling you from experience. In this industry, I only need 5 amazing years to make, save, and invest 20 years worth of income.
Great point.
I've done it twice. Twice in 20 years, I've gone on 5-year runs, and I'm trying to do it one more time.
Yeah.
Like, we're trying to do that one more time.
We're in it.
It'll be 26, 27, 28, 29, and 30 for us.
Yep.
Right? That'll be our 5-year run. And I'm going to try to make as much as I can so I can save as much as I can so I can invest as much as I can. So that when and if robots are doing everything and we're on universal income, life's amazing. Supposedly, I'm going to get 1 year younger every year I live. Supposedly, they're going to be able to molecule size like iPhone implanted in my brain. Cool.
No.
And I'll have,
universal income's coming. Like that's a real thing.
you.
Elon Musk predicted it.
And I'll have this wealth. Like hopefully I can leverage that wealth. I don't know, but I'm curious. What are y'all's thoughts? If you're on YouTube, use the comment section. I know most of you listen on Spotify and Apple, and when you do, we say thank you. Just make sure you give us a 5-star review. That's how you invite more people to this content. If you're on YouTube, click subscribe, comment below. I'd love to get your thoughts and your feelings. We appreciate you coming to hang out with us. If you're a mortgage broker or a loan originator and you are looking to level up, we have 4 ways that you can come invest with us and become your company's next top producer. All that information can be found on our website. That's tloponline.com. Check it out. While you're on that website, sign up for my newsletter. It's free. I write it myself. It comes out once a week. And when you sign up for the newsletter, I will invite you to 1 masterclass per month. It's a free coaching call, no charge to you. And you get invited because you signed up for the newsletter. Anyone looking to take a cruise, go on a fun vacation, come hang out with us September 14th through 18th. It's TLOP Unite. It is the Caribbean Takeover. It's our first ever mortgage event. We're doing it at sea. All that information can also be found on our website, tloponline.com. He's Marketing Mike. He's Money Mark. She's Special K, a.k.a. Karina Mojica, and I am your host, Dustin Owen. We appreciate you coming to check out today's show. That's all the time we have for you today, but we look forward to catching you on the next episode. Peace.